Okay, so the Trump administration, more importantly, the FHFA director, Mr. Pulte, who is a ginormous success in the real estate development business, he's the director of FHFA, and FHFA is the umbrella that covers Fannie Mae and Freddie Mac mostly. And so he's trying to direct Fannie Mae and Freddie Mac to, be more profitable, re-examine what they do. And then also, I'm sure you've heard, they're trying to go public. They're trying to get out from under the government's control and be fully public entities now, although they'd probably still be GSEs, meaning government, what's this? Not subsidized. I forget what the S is, but anyway, the GSEs, that they're still going to have the American people's dollars behind them, but hopefully way less than they are now. Right now, they're completely controlled by the government. So they are proposing now a 50-year mortgage. So right now, Fannie Mae and Freddie Mac, the longest term loan they have is 30 years. Although I haven't seen this in the press, so hopefully when I put out my op-ed, people will realize this. During the mortgage meltdown, during the Obama years, they did modify loans, and a lot of those loans, to make them affordable, they often changed the interest rate from 6.5 down to 3 or 2 or whatever, but they also rework the loan terms. So there are already a lot of Fannie Mae loans and Freddie Mac loans out there that are 40-year terms. So the big freak out that's going on is a little exaggerated because it's already out there. It's already in the bond market. So with that said, these would be fresh mortgages made to be 50-year amortization instead of 30. Now they may compromise and go 40, but basically when I took a $600,000 mortgage at 6%, the difference between a 30-year amortization and a 50-year amortization, I'm going by memory now, which is not great, but the 30-year amortization was something like $3,500 a month, and the 50-year amortization was something like $3,000 a month, or a little closer to $3,100. So it was about a $400 or $500 per month savings. It's not really savings though. You're just paying less to principal. You're paying down your loan less. So when people say it's savings, that's kind of technically not true, but it is a budget savings in the sense that your payment's not as high as it would be. So there are some pros and cons to all this. Let me just do this properly here. So the benefits for the buyers are going to be like the lower monthly payments, increased buying power, but then that means, should you be stretching if you stretched out your mortgage? I don't know, but increased buying power for sure is a benefit. Helps some first-time buyers qualify better, or again, stretch into more home. And there's like long-term fixed rate stability. So if you can have, now if you could have a 2% for 50 years, that would have been better. But no matter what the interest rate you're getting, it does create stability if you can have it for longer. Now, truth be known, the average life of a loan is not 30 years, it's not 50 years, it's not 15 years. The average life of a loan is 5 to 7 years. And that's because people move, people refinance. So again, people who are sounding the horror bells that, oh my God, people will never own their home. Not a lot of people own their home anymore. So there's definitely some arguments that don't make sense out there. So the top concerns are what those people are talking about. So very slow equity buildup, right? So your principal's barely touched for the first few years anyway, but now you've stretched it even longer. So there's even less equity being built. You have much higher lifetime cost of the interest. So when you have a 30-year loan, if you see it to the very end, and that's where a lot of these arguments make no sense because barely anyone sees the loan to the end. There's a small percentage, but few. So if you calculate the interest that you pay all through 30 years or all through 50 years, that extra 20 years is going to cost you. If you, I've done little tests where I say, okay, what if we round out this mortgage $100 or $50? You often are cutting like 2 to 8 years off the loan just by rounding up that little bit. So that cost of interest, when you just pay the minimum for a very long time, it's double and triple. Like a 30-year loan, typically you've tripled the cost of the loan. So if you borrowed 200,000, and it depends on the interest rate, but if you borrowed 200,000, you're paying back 500 to 600,000 if you see it all the way through the 30 years. So keep that in mind. Then there's greater risk of negative equity. So what if the prices of housing, what if the value of your home goes down and you haven't been aggressive at paying down the balance? Then you have a smaller amount of equity, right? And then you might have that debt stretching into retirement years. So I saw Mr. Wonderful from Shark Tank saying, you get a mortgage at 50, because now the average, or is it medium? Anyway, the first time buyer age, the average age is 40 years old now to buy your first home. So he's saying, if you take a 50-year loan when you just got your loan at the age of 40, that means you'll be 90 years old and still paying a mortgage, which we all know that's probably not true, but anyway, it was funny. So the impact on realtors, though, is that more buyers may qualify on paper. Great. That increases your pool of a buyer that you have. And then it could be a tool to help high cost markets like ours. And here in California, where the starter homes are $1 million, like, hello. And then you might increase the demand and competition for the housing. So just like if rates drop, more buyers will come out of the woodwork to buy homes, right? So if they drop the mortgage payment by stretching the amortization or the time that you pay the loan, $400 savings from my example earlier actually equates to about $70,000 to $80,000 in buying power. So that is quite a bit, but then that might put prices higher, right? So for mortgage investors, there's not a whole lot of good to this, because the biggest thing to me is the MBS pools, the bonds that back up the Fannie Mae, Freddie Mac loans. Those guys will have interest rate risk. The longer you hold the bond, the longer you commit to staying with a bond, the more risk you have that if interest rates go up, your bond is not worth as much, right? And then you have to try and get out of that, which costs you money to get back into another bond. Now, if interest rates go down, then that's going to help the bond investors. So that's kind of that. So why it's not good, may not be good for Fannie Mae and Freddie Mac is just, again, the longer exposure, the risk that that these, just like when they had the zero down, Fannie Mae, back in the day in 1994, Angelo Mazzillo, who was top-notch, the CEO of Countrywide, said, what's the difference between putting 3% down or zero down? He said, we should eliminate the down payment. And his pushing for more and more flexibility was basically what kind of did in the mortgage market and caused the mortgage meltdown. So we want to be very careful of unintended circumstances that happen because we stretched and stretched and stretched. It seems like that's what's happening, which then Fannie Mae and Freddie Mac will be just like they were in 2008, with a bunch of loans that are non-performing and have to be taken over by the government. So I think this is just a big circle coming back to a bad thing, but there are pros and cons, and it's for everyone to decide. And so the truth of the matter is that we already have 40-year loans. I can offer them all day long with what we call non-QM lenders, and they, it's not very popular. I don't have a lot of clients that want a 40-year loan. So I don't know who's going to want the 50-year loan, except for the lower payment. I do, however, have a lot of high income people that want the flexibility of the interest-only loans. So those loans are still 30-year loans. They could be 40 if you want it. 30-year loans with the first 10 years interest only, and then the next 20 years are principal and interest. That's good for someone who gets big commissions or has fluctuations in income. Like, that's who that's for. That's not for your first-time buyer putting a small down payment and won't see very much increases in income, right? So if your income goes up 3 to 4% a year, you probably don't want to take interest only, because you may never, life will suck that money right out of your bank account. So do you really want to think, oh, in the future, I'll pay extra? After doing this business for 35 years and thousands of clients, I can tell you that that day does not come. Usually people have to see a lower interest rate and refinance to a principal and interest loan. So that's my take on that. But if you really do want a 40-year loan or an interest-only loan, it's already out there. We don't need Fannie and Freddie to do that. So if you have questions, you can just contact me, and I'll be glad to go over any scenarios you have.